Have you ever wondered if a company with blockbuster sales is actually healthy, or if it just looks good on the surface? Well, today we're going beyond the headlines. We're going to give businesses a full financial health checkup using a really powerful set of tools called activity ratios to check their vital signs. You see these headlines all the time. Companies hitting $1 billion in revenue, and we all think, wow, they must be doing great. But does that really tell the whole story? Big sales numbers are awesome, but they're no guarantee of a healthy, efficient business. So it really begs the question, right? When you see that giant sales figure, what does it actually tell you about how the company is doing on the inside? Well, the answer is a lot more complicated than it looks, and that's exactly what we're here to unpack.
Because the truth is, that top-line number, that big revenue figure, it can be pretty misleading. The real story of a company's health isn't just about what it sells, but how it sells it. It's all about how efficiently it operates, day in and day out.
And this is where our business health checkup really begins. To figure out what's actually going on, we need the right tools. And for us, those tools are activity ratios. Think of these as our stethoscope, our blood pressure cuff for a company's finances. So, what exactly are activity ratios? Well, simply put, they're metrics that show us how efficiently a company is using all of its stuff, its assets, to make money. They don't just tell us how big a company is, they tell us how hard its resources are actually working. Okay, so our first test is to check the financial pulse, the flow of cash in and out of the business. And this is critical. A company can look profitable on paper, but if it can't manage the actual cash coming in and going out, it's basically on life support. The first ratio we're going to look at answers a very, very simple question. When a company makes a sale on credit, how fast does it get the cash from its customers? We measure this with something called the trade receivables turnover ratio.
And the formula for it is pretty straightforward. You just take the total sales you made on credit and you divide it by the average amount of money your customers owed you during that time. That final number tells you how many times a year you turn those invoices into actual cash.
So what's a good diagnosis here? Well, a higher number is almost always a great sign. It means the company is really on top of collecting what it's owed, and that cash isn't just sitting around in someone else's bank account, it's flowing back into the business where it can be used. All right, now let's flip the script. Let's look at the other side of that coin. The trade payables turnover ratio answers the opposite question. How quickly is the company paying the bills it owes to its suppliers? The formula is a similar idea. We take the total purchases made on credit and divide that by the average amount we owe our suppliers. This tells us how many times, on average, the company pays off its own bills in a period. But here's where things get a little nuanced. See, unlike the last ratio, higher isn't automatically better here. If you pay your suppliers too quickly, you might be draining cash you could be using for other things. But if you pay them too slowly, well, you risk damaging those really important relationships. The healthiest companies find that sweet spot right in the middle. Okay, we've checked the cash pulse. Now it's time to pop the hood and take a look at the company's core engine. We want to see how efficiently it's using its key assets, like its inventory and its day-to-day operating cash. First up, we've got the inventory turnover ratio. This one answers a super important question for any business that sells a physical product. Is your stuff actually flying off the shelves, or is it just sitting in a warehouse somewhere, gathering dust and tying up your cash? Now, pay close attention to this formula, because there's a key difference. We're using the cost of goods sold here, not revenue. This is the only one of these turnover ratios that does this, and it is a critical detail for getting this right. In fact, we'll circle back to exactly why in just a little bit. For this ratio, a higher number is usually a sign of good health. It means a company's managing its inventory really well and sales are strong. But of course, context matters. A fast fashion brand might have an inventory turnover of 40, while a luxury car dealer might have one closer to 2. Both can be perfectly healthy for their industry. And our final core ratio is the working capital turnover ratio. This one kind of gives us the big picture view. It answers the question, for every dollar of operating cash the company has, how many dollars in sales does it manage to generate? And the formula really reflects this perfectly. It's a direct comparison between the sales you're bringing in, your revenue from operations, and the money you have on hand to run the business day to day, your working capital. So at the end of the day, a higher ratio here points to some pretty impressive efficiency. It shows that management is really good at using the company's operating funds to drive more sales. It's all about getting more bang for your buck.
Okay, so remember how I mentioned that using cost of goods sold for the inventory ratio was a really big deal? Let's quickly talk about why getting that number right is so important because it can totally change your whole analysis.
Look at this side by side. It all comes down to where you start your calculation. If a company says its profit is 10% of revenue, then for every $100 in sales, the cost was $90. Simple. But if that 10% profit is based on cost, the math completely shifts. Your cost is $100, and you need to sell it for 110 to hit your margin. It's a subtle but really powerful difference. All right, we've run the tests, we've checked all the numbers. Now it's time to put all these results together, read the final diagnosis, and get that complete picture of the company's health. And this is what our complete health profile looks like. It's never about just one single number. It's about answering these four basic questions. Are you getting paid quickly? Are you managing your own bills wisely? Is your product actually selling? And are you using your money efficiently? Together, they tell a really powerful story. So, the next time you see a company's huge revenue number flash across your screen, I want you to think about this. Are you just going to see the price tag, that big, shiny sales figure? Or are you going to know how to look a little deeper and check for its pulse?